Hi, and welcome to the Venture and Capital interview session. Today I have with me the Portfolio Manager of the Emerging Opportunities Fund, Mr. Richard Ivers. Thank you, Richard, for coming on.
Hi, Steve. No problems. Good to be there.
Mate, obviously, now normally we're sort of doing interviews with different VCs and different family offices and different investment groups. Now, obviously, you're on the listed end of the spectrum. So very curious, firstly, give us a bit of an introduction to your fund, and also I'd like to congratulate you. You just mentioned sort of a bit earlier that recently you won the number one sort of small cap fund of the year. So congrats on that. So I'd love to hear your sort of thoughts on how you're looking at things at the moment.
Thanks. Yeah, so I run the Emerging Opportunities Fund, Steve, and that's a fund that invests in Australia and New Zealand outside the top 100 companies in the market. So it's defined as often known as small caps. And what that means is up to about $4 billion market capitalisation and below. And we typically invest sort of down to about 50 million or thereabouts. And we don't really go much further down than that. Yeah, in terms of the number one fund, that was great. It's actually it was based on performance, so the Mercer data for the FY20 year. So we delivered 18% return in a year when the market was down 6%, which is a really good result. It was our first year in the survey as well. But what it actually comes down to is that our focus is very much on capital preservation, and so we typically do much better when the market falls. We beat the market consistently when the market falls. So that came through in that year. I mean, it was a very unusual year, and a year in which it turned down so quickly. COVID, once it started to go outside of China, the markets fell away very sharply. So it kind of, there wasn't much time to adjust your portfolio. It really exposed what sort of risk was in there. And so it was a year in which we performed very well, and through, a good first half, so the 6 months up to December, and then a really challenging second half. So to be number one in that year we're very proud of.
Yeah, well done. And I imagine, like, when you're sort of chatting with people, the first question they want to ask you is sort of what stocks are you looking at right now, especially with that sort of performance. So over the last sort of 12 months, what have sort of been your star performers in your portfolio?
Yeah, so over the last 12 months or so, the best performers have been companies like Fisher Paykel Healthcare, which is a global healthcare business. It's actually a beneficiary of COVID. They provide humidifiers and some nasal cannulas that are used in the treatment of COVID patients when they're in ICU. So that was one of our top performers, and I think it's one of the highest quality small caps in the market, and it goes back to our focus on quality, but it's actually, unfortunately, just went into the large caps last Friday. So it's sort of going out of our ability to invest, unfortunately. Another one was Breville, which is an Australian-based business, a bit like the Dyson of Australia, in that they're incredibly innovative. Yeah, and develop products that are often in boring parts of the market, like kitchen appliances, but develop innovative products in the space and where the competition is relatively low. And another one, the third really good one was City Chic. So it's a reasonably well known among small cap investors, and that's a retailer for plus size female market for apparel, and it's now around about 60% online sales. So it's transitioned its business very much from bricks and mortar to online, and which is obviously a high quality earning stream.
So tapping into your mindset, how do you, like, for you, what is your process, I suppose, for discovering opportunities which you're going to look to invest into?
It's a lot of the ideas and our process revolves around company visitation. So putting COVID period to aside, I typically do around 500 meetings a year, so that's about 2 a day. And I've been doing that over a long period of time. So I've been in this market for about 17 years. So you can develop a long, big sort of database, if you like, of knowledge of businesses and how they perform through cycles, and how management, what they're like, and some are very bullish and some are typically very bearish, and you get to understand how they communicate. And more recently with COVID, that company visitation program has accelerated. Both because things are changing, so you just need to stay up to date with what's going on more, but also because of the benefits of Zoom, like us talking today, means that I don't have to fly to Sydney anymore to see companies. I can do it much easily over Zoom, which means that I've been doing sort of 4 or 5 meetings a day, particularly through reporting season. Yeah.
And just and with your approach, are you typically sort of going on market for your opportunities, or are you typically going into different placements that the companies are doing, or because they're a bit more established, that's sort of not available to you?
Yeah, I mean, a large part of our portfolio will be existing listed companies and companies we've known for a long period of time. But many of those have been doing capital raisings, and we participated in them, particularly in the last 6 months,
Yeah.
where balance sheets got stressed. So, and a number of those companies obviously been listed for a long time. So, companies like Media and Southern Cross Broadcasting, Hello World, Travel, all three of those businesses were, significantly impacted by the lockdown and restrictions on movement, and revenues shrunk significantly, which means they need to support a capital markets. And we participated in that. In terms of IPOs, we do participate in them as well. I mean, we're looking for ideas wherever we can find them. And IPOs are often a great place to find ideas because they're new to the market. They have to be priced typically attractively to not always, but typically attractively to get that capital. So we actually spend a lot of time looking at IPOs, and they're a great source of alpha for us. Yeah.
So you mentioned about participating in some companies that sort of may have been stressed due to COVID. So obviously, with those companies, you're taking a long approach. What is your thoughts about what is your thoughts around the business models that you think are most likely to bounce back sort of faster than some of the other companies?
Yeah, it's almost like you have to look at those which have been hit the hardest to look at the opportunities, and they're often the cheapest. But there is sort of first in, first out type businesses, and we've already seen some of those rebound. So businesses like Bapcor, which used to be called Bursons, which is the auto parts maker, which really got hit hard as people stopped driving. The mechanics closed back in March, but then they reopened and people took their cars back to the mechanic, and they've seen sales ramp up really quickly. And the retailers as well have been very strong, particularly homewares and the like. After an initial slowdown, they ramped up, and many of them are record profit levels and record sales levels. So those are the early ones that have come out. But then you've got the longer dated ones, things like travel, which are dependent on borders opening and flights starting again internationally. So there's a lot of different stages through that process. And it's about looking for value and where you can find those that are attractively priced and taking a longer term view. So we're willing to buy, like Hello World, for example, as I mentioned earlier, fully knowing that international travel is at least probably 12 months away at a significant level. And so earnings are going to, some solid, decent, high profitable earnings are going to be some time away. But if you look out further, 2-3 years, the stock's trading on sort of a 7 or 8 times multiple. So, and typically trades on around 13-14 times. So you can see 50 or 60% upside potentially if you take a longer term view. And the balance sheet is capitalised well. So you're not taking that risk on another capital raising.
Now, you mentioned that you're looking sort of for value stocks. Now, obviously, two areas which have done really well during COVID has been sort of technology and healthcare. How are you, now obviously tech is, there's been a lot of sort of, let's say, high valuation, sort of more focused around growth. How are you approaching value in dealing with tech companies?
Yeah, so we are a GARP investor, and so that means it's growth at a reasonable price, which means that we're looking for growth businesses, but we actually have a valuation overlay, which is exactly as you said. So we typically, like in terms of the buy now, pay later space, which is got a lot of publicity recently, we don't typically play in that space because firstly, they're not profitable, and secondly, that's it's increasingly competitive in that space. So just about every company we own is profitable. It's very rare for us to own one that's not. It might just be temporary ones like Hello World, for example, is going through a tough period, or Southern Cross Broadcasting. But we are risk averse, and downside protection is a key part of our investment process. So when we look at technology, we're looking for businesses that are reasonably priced. And we've participated in businesses like Redbubble in the last few months, which is another one that got hit very hard in the downturn.
I've been following them since 2010 when we were chatting with them, because obviously that was sort of in pre-IPO. But
yeah. And you would have seen that like their sales accelerated incredibly out of of April onwards. So they're typically growing sales around 30%. It accelerates about 130%. So and you can actually get they're actually reasonably valued now.
Yeah.
There's obviously the question marks around the duration of the sales. So, what's really happened in the last 6 months or so is goods have been very strong. People are home, incomes have been strong, so they've been buying things, and it's typically been goods. And services, things like travel and international education and the like, have been very weak because people can't go out and do the normal things that they would like to do. So you've seen that real spike in goods versus services, and so we're sort of very focused on how that might revert next year. Redbubble is one of those ones that you've definitely got to step up, and you can actually justify the stock price by where they've got a sort of a longer duration benefit from this uptick in sales. So those customers that they've got will stick around. It's just the level of growth that's very, very unknown by everybody, really, probably even the company. And there's other tech businesses that you can buy too that are actually reasonably priced, but might not actually be known as typical tech stock. So City Chic, as I mentioned, 60% of sales or thereabouts are online sales. It's effectively a tech stock, but it's strictly speaking a retailer, and you can buy that on about 20 times earnings. So that's reasonably priced. And News Corp's another one that we like. So that's one that it's known for its newspapers and Foxtel, which are really poor structurally challenged assets. But they're at a significantly negative valuation. If you look at the other businesses, things they own 62% of REA, which is one of the highest quality online businesses in Australia. And they own Dow Jones, the Wall Street Journal. Around 60% of its advertising subscriptions now are digital. So these there's a lot of high quality tech businesses, even within an old sort of business like News Corp. So we're looking under the cover, if you like, and trying to find value that way.
And if you're thinking about, I suppose, and I'm just curious to know your own, JobKeeper is about to be removed, right? From how do you expect that to play out across the market, so especially in your area in the small caps?
Yeah, so there's a question mark around incomes. I suspect that JobKeeper is trailing off, so it's tapering down, and there is an end date of early next year. But I suspect that if the economy stays weak and if the virus becomes a big issue again, that there'll probably be government support. We've seen this consistently. So governments, they do stimulus, but for short periods, as long as they need to. They don't want to do long dated stimulus because they don't know how long this is going to be an issue. So if things do deteriorate again, I suspect there will be more extensions of JobKeeper and the like. And we've actually got a budget coming up early in October. There's already talk of tax cuts being brought forward. So I think the government is very much focused on supporting the economy, because after all, this is a very unusual downturn. On most downturns, it's excessive speculation, or like the GFC or the tech bubble. This one is very different. It's been a health crisis whereby the government has actually forced the downturn appropriately. But there's no moral hazard with them providing support, whereas there are with other downturns. So effectively, they need to provide support. So they may actually surprise on the upside in terms of the level of the support that's provided, I think.
What I'm curious about is that my just from my feeling and my perspective and what we're seeing is it feels like the speed of business has picked up. As far as you mentioned about, you're on five calls a day now rather than being 2 calls before. So what becomes curious to me is how that actually translates into whether it be deal making, whether it be revenue, or even just the general bounce back, especially from the small caps in general, because typically, obviously, they are a bit more agile. They are, a lot of them sort of will be on, basically it wouldn't have been that difficult for them to go sort of completely cloud-based. So, when you're talking about the reopening up of trade, it's like obviously the desire to travel will be quite strong because, most of us, this is the longest I've been at home in, it must be at least 2 decades. So I'm curious as far as what that speed of business looks like when things open back up and how quickly it does sort of come back. In the reopening of trade, what do you see as the areas that sort of will look to benefit from that?
Yes, travel's the obvious one. Now, particularly
And hence Hello
tourism.
World from your side.
Yeah, particularly tourism.
Yeah.
Business travel, there's probably a little bit of a question mark around whether it will all come back because of the use of Zoom.
Yeah.
You know, and one of the interesting things of which you touched on, so we've just come through reporting season, so where most of the companies report their results in August. And I met with probably 100 companies over the last sort of four to 6 weeks. And cost cutting has been just about every one of those businesses. And the use of technology is a means by which they can reduce costs and gain efficiencies and productivity gains. So that's definitely a thing. And, you know, you're seeing some of the tech businesses benefit from this. And it's probably got a longer duration to it too. So there's probably a longer term benefit from it. I think we'll all use Zoom. Many of us had never heard of it, 6 months ago. And now I think we'll all probably continue to use it for sure.
Well, let's be honest. We're both enjoying more sleep and not doing overnight flights to anywhere, or the usual sort of time zone issues. I said there's definitely some benefits to it. Curious. I'd have some curiousness on the entertainment side. Obviously, that's been an area that's been massively impacted. Is there any opportunities you're looking for in entertainment?
There's one called United Malt Group, UMG is the stock code, and that is a malt star, and it provides malt for breweries and whiskey manufacturers. And so it has a exposure to entertainment, if you like, indirectly because of the consumption of beer and whiskey. And so its sales have been hit because of the lockdowns and bars being shut and the like, and craft brewers in particular being hit. And that is a really high quality business where it's a global business. It's Australian business listed only here in Australia. It was recently spun out of GrainCorp, and it is the quality part of that combined business. So the GrainCorp that's left over is more of an agricultural type play, whereas the United Malt Group is a more consistent, high quality business. And typically in demergers, there's businesses do better as well. And that is, a play on entertainment, if you like, people going back and being able to socialise again. And it's trading on around about 19 times PE. If you look at the earnings it made in the last 12 months before COVID. So, and that's a business that could trade well into the mid-20s potentially as things normalise. And then you'll get this big uplift in consumption when people are allowed out to go and do the things that they all enjoy, particularly here in Australia, as we know. Especially
the Victorians.
That's right, yeah. That's right, because I am in lockdown in Victoria, and that's what we were talking about earlier, Steve. Yeah, I'm not allowed more than 5 kilometres from my home.
Normally at this sort of point, it sort of comes in, I like to ask sort of what's your thoughts are for the next 5 years, but I'll take a bit of a different approach for you. As a final question, if you were to pick 5 stocks that you're currently looking at that you're sort of interested in and sort of evaluating, what would they be and why?
So 5 stocks for 5 years? Okay. I'd say like City Chic is one that I think is fantastic. I think it's got a long duration of growth, and it's in a growing market. They're also using this downturn to acquire online businesses, typically at 1 or 2 times, as low as 1 or 2 times earnings, because they're coming out of bankruptcy, which is, so they're really making the most of this downturn. They're going to come out a lot stronger. They've got a fantastic management team. Another business that we own is Auckland Airport, which is a play on that recovery trade. So it's listed both here in Australia and New Zealand, and it's effectively the monopoly airport in Auckland, and it's the largest airport in New Zealand. So, the vast majority of any flights in and out of New Zealand internationally go through it. So it's a fantastic, high-quality business that you can own, for decades. So that's one that we like, and it'll also benefit from lower interest rates for a long period of time. It's effectively a yield play, and as people chase yield, they'll compress the yield on a business like that, which means that the share price gets pushed up. So that's 2. Another one I like is a group called EQT, which is Equity Trustees, and it doesn't get a lot of publicity. It's not well covered by the brokers either. And it's been around for over 100 years. Its chairman is currently Jeff Kennett, although he's about to retire. So a lot of people would be aware of him. They have 2 main sides to the business. There's the corporate side of the trustee business, whereby the beneficiaries on that from the Royal Commission, whereby there's a push towards independent trustees, and also transactions, businesses like Colonial being sold by CBA or Commonwealth Bank. And when the purchaser buys these businesses, they look at the trustee role and typically use an independent trustee. So you've got that thematic of contract wins coming through, and a real, EQT is one of two main players in Australia, along with Perpetual. And on the other side of the business, they have the private business, which is, and a big chunk of that is perpetual trusts. So when typically someone wealthy, they leave in their will a charitable trust, and they'll allow equity trustees to be the trustee of that trust. So equity trustees are doing social good from that behalf, and they're also managing the money. So the trustee of the money, also managing the money. Typically, their fund manager's manager, and they distribute the money. So they earn fees through all of those. And given typically the person has died, they don't typically leave. That's a business that they'll have for a very long period of time and will grow as well. It's almost like a toll road that grows over time. So what are we up to there? Is that 4?
3.
Sure.
That's 3.
Three. Okay, I've got 2.
Oh, look, we can stop there if you can. But that's a really, really good insight, the way you're thinking. If there's any more you want to mention, happy for you to do that.
There's one little business over in I don't know whether your investors look in, I know you've got some international investors, but there's a business in New Zealand that's not listed here called Mainfreight, which is a logistics business. And you might see their trucks, they're blue trucks driving around. And it's a global business as well. And it's located in Europe, the Americas, including North America, Asia, and particularly big here in Australia and New Zealand. And they've grown their earnings every year for the last 10, 15 years, except for the GFC 1 year. And they have an unusual culture whereby everybody in their organisation gets a bonus based on profit growth in the location they are based. So even the person who's sweeping the floor can qualify for a bonus, which tends to drive entrepreneurship and incremental profit growth. And it's a very one that doesn't get a huge amount of attention, but is a consistent grower year after year after year. And is a long-term compounding business, which is what we like to invest in. Businesses where you can grow your capital 10 to 15% year after year, and over time that turns into a significant amount of money.
Brilliant. And I have to say, from our perspective, we love uncovering basically companies and opportunities sort of years before the market's sort of even thinking about it. So, you would have seen in the last sort of 6 months, there's been like companies like Atomo Diagnostics, 4D Medical, all the high risk, they've all been sort of our clients sort of 5-7 years. Aroa Biosurgery is another one, was a client of ours about sort of 7 years ago. And I love watching their journey and watching how it unfolds before they go through that sort of listing process. Obviously, you're watching it whilst they're actually listed companies. And I find it interesting to discover those gems that most people are sort of overlooking. Yeah,
and then we're in a privileged role, I think, Steve, to do this job and look for businesses and opportunities like that. I mean, I love it, and there's another job I'd like to do more than this. So it's exciting. And,
Well, to finish off, Richard, how can people find out more about your fund? Now, obviously, we can put a link in the video. Is there any other, what's your website, and how can they sort of get more access to your information, or even find out more about the fund?
Yeah, so it's Prime Value Asset Management is the organisation, the boutique fund manager that I work within, and the Emerging Opportunities Fund is the fund within that. So you can go to our website, it's primevalue.com.au is the website, and I think there's a green screen where you can see the name as well.
Just in case you missed it.
Yeah, it's better than my cracked walls in the background though, Steve. I'm at home lockdown, so so that's the easiest way to find it. We're actually going to go onto platforms and go through the Planner channel soon, but that's probably later this year or early in the next year, depending on how many disruptions we get from COVID in the coming months.
Fantastic. Well, Richard, thank you so much for your time. I really appreciate you taking the time to sort of have a chat with us, sort of give your insights into how you're investing at the moment.
No worries. Thanks, Steve. Thank you for having me.
Thank you.